Good afternoon, ladies and gentlemen. Welcome to the Angus Energy PLC Geothermal Update Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where appropriate to do so. These will be available on your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to George Lucan, Managing Director of Angus Energy PLC. Good afternoon, George.
Thanks, Paul. Good afternoon, everyone. We've got some 42 slides here, and it'll be a great relief. I'm not going to cover them all. We'll cover about 15. We may use some for the Q&A session. So I hope to be not more than 30 minutes here. I'm going to jump straight in. The government's white paper last year made it very clear that oil and gas is living on borrowed time, and we've taken that to heart, as have most of our peers in the onshore industry and many in the North Sea. What we're looking at is aligning ourselves with the way the public thinks, the government thinks, local councils think, our regulators think. And we're doing this in the most efficient way possible. We're using the skills we have in drilling and recently in high pressure and high temperature work to get into deep geothermal drilling. That's drilling 5 odd kilometers down to get super hot water to generate electricity principally. And I think the other of these boxes, these mission boxes, the other ones that I draw your attention to is low cost. Angus has always held itself out to be a low-cost player in the market. It's relatively low overhead compared to many of our peers, and that's something we hope to bring, that sort of focus on cost we hope to bring into geothermal, which up until now hasn't really been undertaken on a wholly commercial basis. It's always been substantial amounts of grant money. But other than that, these aims, I think, are self-evident. We're aligning ourselves with the general tenor of the times. It's not to say we don't have an eye to our hydrocarbon assets. As I've said before, we aren't purists. We're drillers. And there will doubtless be an Indian summer in both gas and oil prices for the next 2 or 3 years because of underinvestment. But nonetheless, this alignment is absolutely essential if we're to have an eye to a company existing in 5 years' time. If we look at the challenge that the government and the country face on an electricity basis, let's just stare at the graph and worry about the text. This large chunk of purple here is the remaining gas, and this precious little coal to get rid of any longer. Every new chunk of wind and solar that's coming online, and another 10 gig of offshore wind they speak of, doesn't diminish the need for that capacity, unfortunately, because you need to retain backup capacity. We're bringing a new solution, and it's the most important part of geothermal, is its base load. It's like hydro, most of the year at any rate, in that it's 24/7, and it does mean you can retire or repurpose existing gas capacity. Now, that's very important for everyone in the country, and the government in particular, because with every new 10 gig of offshore, retaining reserve gas capacity means ultimately paying more for all of that reserve capacity, and that means the consumer paying more. And I think we'll hear a lot more from the consumer over this winter about how transition is being managed. I'm just going to go straight on. The transport side of the equation, the other aspect of decarbonisation that the government look at the top large blue chunk of that graph. This is sort of final energy consumption across the UK. The first bit's oil, blue at the top, and you're into gas, and the rest is electric, which itself is really half gas nowadays and about half renewable. Now, transport challenges, half of that blue oil block is, of course, motor transport. And if we are successful to transitioning all of those car stock into the car fleet into electric, then you've got to go and replace that energy. And you see that was going to require you to actually almost increase by like 70, 80, 90% the electric capacity of the country. And of course, that's very difficult to do. In fact, as regards upgrading the transmission and distribution work, it's almost impossible. So you can be absolutely certain that if we are to decarbonise road transport, then hydrogen, as well as electric vehicles, are going to be part of the mix. And it's going to be ever more important, the more pressure we put on electric to have baseload generation. So I bring back that again and again. It's, of all the alternatives, it's one of the most attractive that is knocking around today. We also make the point that there will be the potential at many of our sites where we don't have easy access to grid, and the grid across the country, local and national, it operates in many areas at or close to capacity, which is another problem I think that the authorities will face as we explore different types of transition energy. What's interesting and useful is that the temperature for which we take water out lends itself to all sorts of enhancements to existing very standard technology to convert to hydrogen. It's not, of course, an additional source of economics for investors. It's just a different sort of economics. So the wonderful thing about being able to do that locally with hydrogen is that you're no longer tied to sites which have to be proximate to areas of the grid with low capacity. And in the areas we're looking, we can already say that's an issue. Capacity is an issue in the southwest of England. I'll come on to hydrogen in a little bit more detail later. We go straight into the commerciality of it. I think let's start with the bottom right-hand box here. A lot of investors have expressed skepticism about the size of these projects. And if you look at the bottom left, you see a figure of 16 million of equity mentioned on a site basis. Now, in any oil and gas exploration, the lead operator will seek partners. When we had our market cap was a few years back, well north of 30 million, we still wouldn't have gone into any of those drills as 100% licensee. We would always have sought out partners. It's what you do in oil and gas. It's sensible. It's surprising that in the deep geothermal projects done to date, it hasn't been done. And that probably reflects the large amount of state subsidy that has allowed investors to sole risk it. We wouldn't. And if you take, say, a third exploration share, that would be a sort of a £5 million investment in a couple of years' time. And it wouldn't even be £5 million. It would be a modular, staggered investment of risk. So you'd start with £1.5 million to put your share of a disposal well in the ground, prove up at least some of the fracture system, and then proceed to add investment later. And none of this is going to happen for 18 months, realistically. And I don't think that it's beyond the resources of the company, particularly, as I believe we'll start to enjoy a significantly higher market capitalization as investors take on board the reality of our gas assets. So this isn't an immediate question, but it's an important one they've raised. This is not beyond Angus's capability at all. You'll see some frightening figures for debt there. But actually, once the initial wells, 2 wells are drilled, the proposition lends itself quite naturally to staggered or phased introduction of debt. That's not all coming in at once. That 60 million comes in again on a modular basis over 5 years. And with each passing well, not only is there more cash flow to de-risk the proposition, but it's also significantly de-risked by greater knowledge of the reservoir. And then the top 2 left boxes, well, really, these are decent IRRs and decent NPVs for alternatives done on a commercial footing. 8 pence per kilowatt hour may sound large, but we'll come to how we get that. That's a sort of blended rate. Every site is going to be quite different, as we'll see. And the last point to make on the top right-hand box, this is scalable. We could take a site, a single site on a fault system might do 20 megawatt, but a multitude of sites might address the same fault system along different lengths and comfortably get up to 100, 150 megawatt. We believe that the Southwest has at least 2 gigawatt, I think I mentioned earlier in the program. We'll get down to some more detailed economics. It's quite small print here, so I will run through what I think are the key assumptions. First of all, the top left-hand corner, it's a long life asset. So you're looking at 30 years. A lot of oil fields, you might not be looking at much more than 10 or even less. Here, 30 years, it's a real investment. You're not going to get PPAs for much more than 15 years, power offtake agreements. So there's a degree of nebulous economics here. You know, not everything is written in stone, but you can at least make a decent stab at the first 15 years of economics and come to some reasonable conclusions there. I think then the next point to direct attention to is the pricing per kilowatt hour. Right now, we looked at longer term PPAs on the wholesale market, and 6 pence a kilowatt hour, they measure in megawatt hours at £60 a megawatt hour, is achievable right now, and the prices are going upward, not just for the reasons that I mentioned, but there's some more immediate short-term supply constraints, which are holding the next 2 winters quite firm in terms of forward prices. Beyond that, you have the latest government feed-in tariff subsidy system, which is a contract for difference. The current prices for our particular pot were set at about 13 pence, £130 a megawatt hour. Higher than I've written here, 9 to 10. I used a lower value for conservative sake, but the actual price is higher. Although, as we said, the pot is small and certainly won't be able to cover a number of these sites. And lastly, and this is really where it gets much more profitable, is direct sales of heat and electric. So if you're able to find a site with a nearby industrial user, or EV charging station or something of that order, then you can undercut the business tariff, which is about 14 pence a kilowatt hour, and supply direct. So on to the capex per site. We're assuming a £10 million cost for a producer well and a £4 million per disposal well. We would certainly start any drilling program with a disposal well. Really because we don't need to drill so deep. The well doesn't need quite such expensive modifications as a producer well. So we can spend less money and still get quite far down, so it's still 3 kilometers down, and have a much better sense of the reservoir without undertaking further significant risk, investing further significant risk capital. So it again, it's about staged reduction in risk. The actual surface capex we estimate at £5 million per doublet, so the doublet being a producer and an injector well. And again, we are in discussions with turbine manufacturers about doing this on a modular basis. So it's not all, as it was on some of the drills on the continent we can come to, a vast 30 or 40 million euro plant plonked down all at once, and then you discover after your first well that things don't work. This is all staged in order to be absorbable by a mixture of equity and high-risk mezzanine debt. And then I've added also a £3 million charge for connection and or ancillary, which might well be hydrogen electrolysis systems on site where we can't get electric connections. And then there's various OPEX results. At 8 pence a kilowatt hour, as it said on the headline page, we start getting an NPV of £30 million on each site. That's an NPV 10, which is nowadays, frankly, a very high discount rate. And if it's applied at a slightly better rate, those sites where we can get more direct sales, we're up to £60 million a site. But I think we'll come on to this. One of the greatest variabilities in this is not actually the headline price, it's the amount of heat we can convert, the so-called conversion efficiency to electric. That is ultimately where profitability shifts quite dramatically, and this is based on 12% heat conversion. And we do believe, and with reason to believe, that we can do better than that. I'll just go on. This is just to draw out that every site will be radically different in terms of a risk-reward profile and investment proposition for third parties, and so on. And this comes down to temperature below, the subsurface stuff, temperature below ground, drilling depths, the availability of other uses for our heat, or direct use for electric, and perhaps the availability, and this is looking ahead 3 or 4 years, but not that far ahead, of the quantity of electric vehicles and hydrogen vehicles as a proportion of the total vehicle population. So that's just to state this: there is no standard. Every site is very, very different. The offtake prices, the risks, and so on are site specific. This is a very clear indication of the point I made earlier. Your ability to convert more than 12% of heat to electric radically changes the economics, because you're still paying for the same well, but you're getting vastly more bang for your buck with every percent that you increase from 12%. So you start taking a site up from being a £30 million present value into the 100+ territory as you move toward a 20% conversion efficiency. And it's remarkable how little investment has been put into conversion of heat. In fact, it's remarkable how much was done 100 years ago, and how small the advances are in the last 40 years. We can come to that later. These are all the offtake possibilities for heat, and we will on a 12% conversion rate. Say you take a megawatt out of the. Say you're getting a megawatt of electric, you're probably putting 8 megawatt of heat back in the ground without using it at all. So in every site, we'll always be looking with local farmers, local landowners, local councils for any use of heat in an efficient way, and we'll have a plentiful supply of it, and we'll be able to supply it at very competitive prices. And there's everything from greenhouses, animal husbandry, aquaculture, to the heavier industrial processes. Anyway, it's left there just to give people a range of possibilities. Green hydrogen isn't added just to get the buzzword in. It's an essential part of our de-risking strategy, because, as I said, areas of the country have great sites for geothermal subsurface potential, but then the grid above it is tired and strained. And simply won't take capacity. And we hear tales from solar farm owners of considerable delays, multi-year delays, to get access for their full capacity into the grid. It's a real issue across the country. And we'll get only worse, that issue. So being able to have an alternative off-take possibility is absolutely critical. I mentioned here alkaline water electrolysis. It's actually an exceedingly well-established process, and it's scaled and tried and tested around the world in scale, and it's operating in scale, principally in ammonia production. So where we use that is to liberate ourselves from grid and being able to compress that hydrogen and sell it on the open market. The problem we have is that the other producers on the open market, the so-called grey hydrogen, is very, very efficient. It's cracking gas at 1,000 odd degrees into hydrogen, still carbon dioxide intensive, but it's cheap. It's about $1.80 a ton. And we would be more like $2.50, $1.80 a kilogram. And we'd be more like $2.50 to $2.60. So very difficult to beat the economics of gas, as it is even in regular electricity. But as gas comes under more and more pressure to be clean, so the pressure to ask those grey hydrogen producers to get blue and to inject their carbon dioxide back into the ground, or try and use hydrogen itself to generate, to crack the methane, to produce more hydrogen. As those economic costs or burdens are put on that grey hydrogen industry, we think that we can actually come close with green hydrogen, with geothermal, to being able to offer a competitive product. And that will require some innovation, but not a lot. Alkaline water electrolysis is already about 80% efficient, but there's the possibility of using some of the heat that we naturally have to get 1% or 2% more on that efficiency of conversion, and therefore be able to stand eye to eye with grey hydrogen. Not grey hydrogen, blue hydrogen. And no one is going to stand eye to eye with grey hydrogen. This was just to reiterate that this is not a single fundraising or a single drill, but a very modular application of risk capital to a disposal well, a site acquisition planning design, then disposal well, then a producer well, then generation, introduce mezzanine when the cash flow is actually being generated, and then again into the same disposal and producer wells on the same site, up to we think about 4 doublets per site, each one producing 5 megawatt or more, with improvements in conversion efficiency. And again, this is try and graphically represent that risk curve. So we're doing, on the left-hand side, already have done a considerable body of seismic subsurface studies that are contained in the back half of this presentation for those who are interested. And then we start moving into detailed wellbore design and turbine design, permitting, and then we will probably do an exploratory borehole in some sites, and then moving into disposal, producer wells, and so forth. I think everything has been about de-risking this project. So there's lots of ways we can do that. The obvious one from the previous slide is that you approach every investment on a modular basis, spending no more than you need to at that point in time. So at any stage, you can say, right, this is not good, this is no longer a good risk-reward proposition for our money, we'll pull out and go elsewhere. One of the things you can do right from the start, the simple stuff, which occupies a lot of the rest of this presentation, is actually do much better subsurface studies. And the range of the subsurface studies we're doing is something for the rest of that presentation I'm delighted to take questions on today, or rather in subsequent weeks. The second way you can do it is actually just reduce the cost of drilling. Many of the continental drills were, it was an exploratory industry. They were not, if you like, innovating because the project itself was such an innovation. And people tended to be quite risk averse in the drilling techniques. And perhaps there was overspecking here and there. There was certainly a great number of errors. We have errors everywhere, but these are errors which probably shouldn't have occurred. and costs on a lot of those drills spiraled, and it was as well that they were grant funded, because they would have been out and out failures if they had not been grant funded. So drilling costs, and a lot of that is about introducing things that we've learned over 100 years in oil drilling, and somehow I don't think all of that that sort of historical wisdom from the oil industry was easily transferred into the geothermal industry. It was almost as if some of the drilling was done as if from scratch, drilling programs at any rate. So I've described most of the other ways of de-risking, but which is to be modular in every aspect, get cash flow at least going from one doublet before and tries to advance to the next. And then some of the downhole technologies we can do, because there are things we can do inside the well, which will radically improve conversion ability. And we have been in discussions with Cerify to explore some of their technology, as have other members of the industry. And we're also working on thermodynamics of heat flow within the well, seeing what we can achieve there. And there are some particularly interesting, and I hope one day proprietary things that we can do, which have not been done before. So there are a great number of ways where we can innovate here, or simply look ruthlessly at cost and take risk out of the equation. To say, most of these projects today, I can just whiz forward to some of them. Have relied very extensively on local or central government grants. So here's some of the deep geothermal projects coming up. The bulk of them, as you can see, have been in the Rhine, the Upper Rhine basin here around Switzerland, off Germany, and France. And they've received substantial amounts of public funding. There's two in the UK, one down in St Austell, by Eden Geothermal, and one in further out in Cornwall, at the so-called United Dams project. All of these have enjoyed very substantial amounts of taxpayer money, and it's not our intention to be looking at government for anything other than grant to support innovation. We intend to approach geothermal, it's either commercial in the long run, or really it's not for Angus. So everything in the next year or two is going to be about further improving our drilling program to prove that we can take that cost down, which those wells experience. So some of those sites I just showed you had some pretty frightening figures for the cost of a well. And we do actually have those drilling programs, and we've gone over each of them and we've seen where they've gone wrong, and we do believe that they're wrong, that this is a commercially drillable proposition. From government, though, where we could do with help, in addition to an improved offtake environment, is actually an insurance program. So one which would be industry supported but government led, whereby if you drill a well and you don't get the temperature, pressure or fluid flow that you're expecting, there is a payout. And the reason for this is essentially to be able to attract capital. But it's meant to be a net neutral scheme for the taxpayer. So it's not just a call, oh, pay for the well. It's help us attract capital into drilling the well by organising and leading an insurance program to which we'll all contribute. What we would like as well in the longer run is more pressure from government through Ofgem on grid operators to make available capacity on a preferential basis to baseload generation such as our own. It's obviously very valuable compared to more variable forms of generation, and we believe it should be taken into account in allocating capacity. We've made a lot of progress. We have, in discussion with documented heads of terms with a number of landlords now, and we have been identifying and opening discussions with other landlords across the area. So I think we have in total some 8 target sites, of which 3 are I hope proximate. I hope shareholders will see documented evidence before during Q4 on closing them. We've also been in discussion with a number of funding partners, and there is enthusiasm to fund what I call the second layer of risk, the mezzanine style debt, when you've proven out the reservoir and you're showing some cash flow. That style of development finance, similar to that which we raised at Salt Creek, so relatively high margin, but only in situ, we believe, until the full site is built out, and then with a sort of proven 2 or 3 year constant cash flow, rapidly refinanced to more favourable terms. We've also talked to regulators, of course, district network operators, and are hoping to open a conversation with, well, we have begun to open a conversation with National Grid. So we've not been idle. This has been a year and a half of a considerable draw on management time, but I'm going to slightly anticipate a question which I know is coming. Is in our business 2.5 years ago, when I took over, we had great reliance on two wells. One fell away by virtue of the reservoir not being there, and another one fell away by virtue of regulatory interference, or rather planning authority interference. You can't afford to have just 2 assets to play with anywhere in the world. It's insane, and I recognized that when I joined. We have to have a great number, a pipeline of projects. The devotion of management time in our spare moments when we're not putting together Salt completely is essential to actually building out a decent pipeline, because we know how long regulators take in the United Kingdom, and we know how long planning authorities take, and it's not something to whinge about, it's a given, and we have to therefore have multiple opportunities, multiple sites, even within this geothermal sector, if we're going to prevail and grow each year, so that in 3 years' time you'll start to say, well, there's site B is coming online, site D, and so on. I think that's a very important aim. I'll leave you with this happy slide. This is the Larderello well from almost exactly 100 years ago, and there's Piero Ginori Conti waving his stick over the steam, and that's still producing today, quite merrily. It is, in fact, a shallower geothermal well, but it gives you an idea of the reservoir itself. We're not dealing with an oil reservoir that might well water out after 4 years or 5 years. By and large, the record on the geothermal wells is good. They hold their value over a very long period of time. So what we're building here is a very large legacy asset and an exciting utility proposition for debt funders, but something of great value and consistency, which I think will be attractive to shareholders as they realize it's not an enormous upfront undertaking. It's actually something we can approach commercially and sensibly and with an eye to risk and cost. And Paul. at that point, I'd like to
Fantastic.
hand back to you.
George, thank you so much for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But while George takes a few moments to review those investor questions submitted already, I'd like to remind you that the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that George and the team can better understand your views and expectations. George, we did receive a pre-submitted question. Perhaps we can start the Q&A session off with that. It reads as follows. Geothermal is a very interesting prospect, but wouldn't the time be better spent on actual delivery at SFB before embarking on another project in the short term?
Yes, and I get that, and I get people's concern, anxiety about that Salt Creepy project. We have all the bids out with all of the suppliers, and all the fabricators are busy at work. There's a limited amount which we can do in terms of hiring very capable engineering houses around the country, hovering over their backs. I know that this equipment is coming on, and the rest of my team knows that. Unfortunately, making shareholders believe that until they see it may be more difficult, at least some of them. So I do appreciate that, but there really isn't any more hurrying we can do. We have done an enormous amount of preparatory work at Salt Creepy, and it's now up to third parties to deliver equipment. However, every moment where it is necessary, we are 100% devoted to Salt Creepy. So this week we have our HAZOP, which is going through all of the detailed P&IDs and process flow diagrams for all of the equipment, and looking how all the valves are going to interact, making sure there's going to be no accidents down the line, designing the control systems, how we'd like to be controlling the plant on a day-to-day basis. So we're doing all of that work. But there will always be days. And when we are not doing that work, we have been doing this work. And we believe that it's an investment being made for shareholders in the future, and that it will be worthwhile. That answers the question.
Fantastic, George. Thank you very much indeed. If I may just ask you now just to click on that Q&A tab, and just where appropriate to do so, if you could read out the question and give your response from the questions received from the attendees, that'd be fantastic. Thank you.
Yes, there's one from Karen S. Which would be the best sites for this? The answer, there's a lot of detailed answers to that. We want to start with the best, biggest, and easiest fault system. We know where those are. So that's one part of it. Then you want very good, good transportation links. You're not taking an awful lot on and off, but just in site construction and so on. We're talking about the southwest of England, and a lot of the road network is not always in places suitable, even for the most basic forms of access. So that's the second point. As you narrow down, grid is the first point. You want a decent ability to get at the grid and to get your product to market, your electricity that you're generating, essentially. And of course, all of the other aspects of it, where grid is not available, we have hydrogen. So then you're back into road transport. I think the other areas which will be interesting for all hydrogen, localized hydrogen producers in the future, will be electric vehicle charging for the actual pure generation, and for hydrogen vehicle fueling. I think that's a very real prospect in the future. It may not look so now, but by the time we're actually looking at a real significant sizable cash investment in a year or two's time, I think it will already start to be a much more credible prospect. So there's a great range of things. But if I had to say there's one thing above being in the right place in terms of on top of the right reservoir, then it would be being close to somewhere you can sell your product. And the first point is going to be grid, local grid. Can I go to, if that answers the question? Will the life left, Karen has posted another, so I'll go straight. Will life left on your leases give enough time frame to make this economic? Yes, Karen, we'll go for 99-year plus leases. So we will actually be looking at the way in which we are structuring our heads of terms to take options, then relatively short leases, and then much longer leases, each with increasing premiums for the landlord, but at each point we'd have increasing conviction that the investment was worthwhile. So if it turned out after 2 years it wasn't, then we're out of the landlord's hair and we don't pursue the lease any further. But if not, we can have 99, 999, whatever the year lease is, it's acceptable. But certainly not a 50-year lease, because it wouldn't make sense. And I have a question from Chris R. What milestones should we be looking at in the near term from a project perspective? I think the first milestone is site acquisition and knowing sites are, and being able to begin to bring to our shareholders and potential sources of capital elsewhere. That includes potential farminees or co-venturers at an equity level, as well as mezzanine at higher risk debt partners, to see get a feel for their level of appetite for a particular site, and then there will be there'll be some investors who like particular sites, particular reasons, and there'll be some investors interested in the offtake as well. So we don't envisage necessarily that all of the, and I think this is the next stage, the next milestone. We don't necessarily envisage that all of the co-venturers need be commercial co-venturers. Some may be financial co-venturers purely, and it's not an industry regulated by the OGA, so there's no limitation at present on splicing and dicing the risk and the return into all sorts of royalty streams to get the people who have specific risk reward demands, get them what they want, and get the capital for the project at the same time. So we've got a bit more liberty than we have in oil and gas, and I think it will attract a broader range of capital, and there will be some sources of capital who are interested in it because they're mandated to look at ESG projects, and there'll be others for whom it is a contribution to a net zero investment. But I do think there will be a nice broad range of potential providers, co-venturers in equity and providers of mezzanine. I think it will be handsome mezzanine finance, good return with clear exit, and all round. Whilst the figures may look a little bit scary now, I don't see it as at all unachievable in the context of what's being done elsewhere in project finance. So yeah, so in summary, Chris, getting to see the sites and then building a capital base around those sites and co-venturers, supported providers of finance. I'm going to go over to Martin G. This is a question about a placing anytime soon. If so, will existing shareholders be given? I'm not going to answer questions about a placing, because I'm not allowed to. Anything I say about any placing, I'd have to announce the next morning. So I get these questions. I have had them for the last 6 months. I'm sorry, Martin. Everyone on our website has said for 6 months, are you doing a placing? And I can't answer you, because if I answered you, I'd have to go out and do an RNS every bloody morning. Sorry. I have a question from Alan M, who's asking about delays in projects in the past. we have had a history of delay with Salt Fleetby. That was principally a history of raising finance for the project, and that finance was finally raised in June. It took the board a year and 3 months to raise finance. We did waste some time talking with one particular bank for 4 months. It was a very disappointing result. We were trying to raise finance, and point out to you, Alan, during 2019 and 2020, principally 2020, a period which saw some of the worst oil prices in recent history, and very considerable hostility toward hydrocarbon from a number of parties, and a reluctance of private capital to invest in the industry. So yes, there was a long delay getting that finance. And yes, you'd also be right to say that in general, the regulatory timeline, both at planning and with our principal regulators, has grown over the last 5 years, and all of the regulators have got tougher about every aspect. We were in a more unfortunate position than most, in that I took over a business with 3 assets, which one was already in a regulatory backlog when I joined, and the other 2 required significant workover to bring them online. So there are 2 things there. Finance was very difficult in 2020. It's significantly easier now, and regulatory for hydrocarbons, I'm afraid, is going to get still more difficult. And we're conscious of that in recent documents on flaring, which we have to be particularly careful of now that we're an operator of a gas field. So yes, the regulatory world for hydrocarbons is not going to get any easier, and nor is the planning world, for that matter, even if we have significant shortages this winter. But that's part of the course. One of the joys we've noticed since being in his geothermal, building this geothermal project, is that when we go and knock on the door of council or a regulator, we're met with a smile instead of a computer says no moment. So I would hope that geothermal won't actually encounter the same level of regulatory delay which we have been encountering for the last 3 or 4 years in onshore hydrocarbon, in answer to your question.
George, thank you very much indeed. I think we've actually covered off all the questions we've received through from investors. And of course, if any further questions are submitted, you'll have the opportunity to review those. And perhaps before we redirect the attendees to give you some feedback, if we could just get a final snapshot from you, George, that'd be great. Thank you.
Yeah, well, what I'd like to say, in summary of where we are, I think we're following on from our success. I believe success in transforming the company from oil to cleaner gas. Angus is going to be looking to take its transition one step further into becoming a leading publicly listed originator and operator of a pipeline of industrial scale deep geothermal electricity generation and hydrogen production projects over the next 5 years. Thank you, Paul.
George, thank you very much indeed for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected for your opportunity to provide your feedback, in order that George and the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of George and Angus Energy PLC, we'd like to thank you very much for attending today's presentation. That concludes today's session. Thank you and good